Most people start a limited company thinking one thing. They believe they are going to pay less tax. And technically, they are not wrong. But what most people never fully understand is this. The real question is not how much tax your company pays. The real question is how much of that money actually ends up with you. Because a limited company does not just pay one tax, it goes through multiple layers. And if you do not understand those layers properly, you can lose thousands without even realizing it. In this video, I am going to break this down step by step with no jargon and no confusion. Just a clear explanation of how limited companies are actually taxed in the UK. And by the end, you will understand exactly what happens to your money from the moment your company earns it to the moment it reaches your pocket. Let's start with a simple scenario. Imagine you run a small business and you have worked hard all year, dealing with late nights, pressure, and constant responsibility. And finally, your company generates £100,000 in revenue. At that moment, it feels like success. It feels like all the effort has paid off. But this is where the misunderstanding begins. Because that £100,000 is not your profit. Before you even think about tax, you have to subtract your business expenses. This includes things like rent, software subscriptions, salaries, and other operating costs. So let's say that after all expenses, you are left with £70,000. That is your actual profit, and this is the number that really matters. Now we reach the first layer of tax, which is corporation tax. This is a tax that your company pays on its profits, not you personally, but the company as a separate legal entity. In the UK, corporation tax typically ranges between 19% and 25%, depending on your level of profit. So if your company made £70,000 in profit, you might be paying somewhere between £13,000 and £17,000 in corporation tax. At this point, many people feel relieved and think the hard part is done, but this is exactly where things start to get interesting. After paying corporation tax, the remaining money is still inside the company. It does not automatically become your personal income. And this is where most people get it wrong. They assume the remaining money is theirs to spend, but it is not. Not yet. The moment you take money out of the company, a second layer of tax begins. And there are two main ways to take that money. You can take it as a salary or you can take it as dividends. If you take a salary, it is treated just like employment income, which means you will pay income tax and national insurance. On the other hand, if you take dividends, they are taxed differently, and dividend tax rates are usually lower than standard income tax rates. This is why most company directors do not rely on just one method. They use a combination of salary and dividends, which allows them to manage their overall tax more efficiently. Now let's bring everything together. You started with £70,000 in profit. After corporation tax, you might have around £56,000 left inside the company. Then, when you take that money out, you pay personal tax. And in reality, you might end up keeping somewhere between £45,000 and £50,000. That is your true take-home amount. So here is the key insight. A limited company does not automatically reduce your tax. What it gives you is control. Control over how you take your income, control over when you take it, and control over how much tax you ultimately pay. And when used correctly, that control can make a significant difference. In the next video, I will show you exactly how company directors use this structure to legally reduce their tax. If you want to see that, comment strategy below and subscribe for more content like this. Because here we do not just explain finance, we make it work for you.